everybody. Let's go get this started. So, first, let's go ahead and take some requests. You guys have any tickers that you would like me to look at? Feel free to let me know. Anything that you have going on. Um, and in the meanwhile, we'll get started with the SPY and see how things are going there. Let me get my screen up for you guys so that you can see it. All right, you guys able to see the trading view screen okay?
Yes.
Yeah.
Good deal. And is there still an echo?
No.
Okay, good.
Nope.
No.
Yeah,
All
I'm
right.
here.
I should have said that so definitively just for me. I can't speak for everybody else. Sorry, guys. Let me came up there.
Yeah, there's an echo.
You're funny guy. You're funny guy. Okay, let's go ahead and take a look at the SPY and see what's going up. So yesterday, or rather Friday, was rather interesting. We had that big gap down. It was actually much bigger than I had expected. We had this big drop. Excellent area to take profits. We more than passed the 385 profit taking level that we had called out. So, like if you got out in the morning as soon as like this wick started forming on this candle, then you made out like a bandit. The market started to turn around right as we entered into the afternoon session candle, and that was when everything started to pump. The clue that would have given us a lead on this was the HYG bonds, which if you go to the 1 hour, you'll see that HYG also did the same thing. HYG had been dropping throughout the entire week and also had this gap down. But as soon as we opened the day on that morning, HYG started to trend upward. So this actually is something I should have been paying attention to. I wasn't able to since I was out most of the day at work. But since we had this big candle print and HYG was forming a bullish reversal pattern, especially this three white soldiers pattern that you see here, these three green candles with small wicks, that was a big clue that the market was going to pump. So this is something to keep watching. I keep calling it out because it's so good, and that's why I keep pointing to this. Now, we have to watch HYG closely this coming week because we have the Fed speaking, and part of what I'm anticipating, and the charts will either prove me true or false, but if HYG continues to pump in the form of short corporate bonds going to the upside throughout the early half of the week, then that lets me know that a short-term swing, just like a couple day trades going to the long side on SPY, can be effective. But I want to watch these bonds to see how they react. The meeting with the Fed is going to be where I expect this turnaround, or as we get close to it. So I'm going to be watching closely what the overall trend is for HYG. And what can help with this is put some moving averages on it. And note that before we had been getting rejected off of things like the 50 and the 20 moving average whenever we had gotten some relief bounces out of this. So we had one on the hourly. The 15-minute was actually much more effective. But if you go to the 15-minute, you can see HYG was getting rejections off of the 20, the 50 again here, and then it cut through the 50 here. So we're now in an uptrend. So that's why if you're going to go long on this, if you're going to take a position in the broad market, then going long on SPY, at least for now, is probably the right move. But as soon as you start to see this curling up, like if we get a rejection off of this 200 moving average on the 15-minute and the HYG starts coming down hard, also watch the 100 average on the 15-minute. Or, let's see, the 200 and the 100 are meeting right here on the 30-minute. So that tells me that 75 is probably the highest HYG is going to go before it rejects. So pay attention to the bond traders. They are predicting these moves in the market. They've been doing it very reliably. So anticipate SPY might try to retest this 390 area early next week. If we do get that, and then we see HYG turn around, then this will be the ideal entry point for some puts. I've been hearing a lot about Avaya Holdings. Interesting. All right, so I see this big sell-off pattern. And now we're doing a bull flag. Wow, what a sell-off, man. I'm kind of shocked. Like, I like these things better than Cisco. The MACD is getting really bullish. We got bullish divergences happening pretty frequently on the daily chart. Let's see what the hourly shows us. Okay, so technicals show this has quite a bit of strength in it. That was a nice run in August. It really inversed the market there. Filled this gap very nicely. Let's see. Some insider buys. Let's look at the float. 71 million share float. That's not that big. That's actually pretty small. I like the MACD. The consolidation is very good here. Let's take a look at their financials. I see their earnings have been in decline for a while. Who's been tracking their, has anybody here been tracking their financial statements or sitting in on earnings calls lately? All right, they're just barely positive on their debt to asset ratio. Debts and leases are about $3 billion. They have some money set aside for risks. Okay. So their balance sheet's not great. The debt is a little bit higher than we would like, but they have good book value per share. $4.66 per share is just about in the right spot. You'd like to see this between 5 and 20. And that's just because this debt strongly affects this. But that's an ideal ratio for book value to their debt to assets. EBITDA is affected by that also, or it calculates it, I should say. So they got an earnings coming up in November, and they're anticipated to post a loss. Okay. Well, that gives me some info on their current financial situation. It seems like they're pretty far from any danger of like bankruptcy or financial collapse, which leaves me wondering why the hell their stocks sold off so badly from $24 starting in January. I was wondering, Cisco didn't sell off nearly that badly. Like, they did sell off since January, but so did everybody else, and now they're in an uptrend. They've at least
In
been.
August, they issued disclosures that they have substantial doubt about their outlook, and that was after dropping in January because they issued more shares for debt.
Was that Avaya scrapping?
Correct.
That you're talking about that the outlook was
Yes,
negative?
they issued a disclosure after their stock dropped
Yeah.
45%. They have substantial doubt about their outlook.
Interesting.
Wow.
That was
Why? They
in
should.
August.
They know why.
Give me 1 second.
I figured it might be guidance somehow.
Yeah, I've been tracking Avaya for about a month now before they actually made this run because the 250 contracts were actually pretty juiced up. But yeah, I'm not really sure why it's been beaten down so much. That was my thing is that, this sector, there's not a lot of competition. These are kind of niche markets, so to speak. You've got Avaya, you got Cisco, and you got Yeelink, and that's it. You
Yeah.
know, Nortel's gone.
Wonder what, well, scrapping will tell us what specifically the issue is.
Okay. I see the debt offering.
There apparently there's an investigation. They have going concern problems, so that like they're really unstable. But there's some type of audit committee investigation regarding matters relating to a whistleblower letter. So they might have some other uncertainties
Right.
that are factoring in.
Yeah. Maybe a lot
Okay.
worse than
So
that.
there's some concerns that they're doing some sort of Ponzi scheme or just cooking their books to make them look a little
Cooking the
better.
books. Cooking the books, TV. That's it.
Yeah,
Okay.
regarding their third quarter financial. Let's hold on, not third quarter. One moment.
That does that is a cause for concern. I haven't seen any companies do that recently. At least not American companies that have done that recently.
They also have some concerns about some convertible notes that they need to address that are in for 2023. So they sound like they got some heavy issues weighing on them.
Mm. They expanded a partnership with Microsoft in integrating Avaya One Cloud portfolio on Microsoft Azure. They got downgraded by JP Morgan. That'll hurt. That'll freaking hurt anytime JP Morgan does that. Yep, their stocks sold off real bad after that. Oh wow. Okay. So JP Morgan made that downgrade on the 11th, and yep, their stock started selling off right away. That hurts. Okay. It seems very oversold to me considering how long the company has been around and how much money they're generating. Their market cap makes no sense right now. This company used to be a multi-billion market cap company. Right now they're 161 million market cap. That doesn't make any sense. What was their
Yeah,
market cap in what was their market cap in the beginning of or at the end of 2019 before we went into the COVID pandemic? Let's look at that. So their market cap at let's just go to January 1st, whatever their close was. All right, they closed at $13.03. So 1303 multiplied by 71 million shares. Even that's kind of low. Like this company generates billions of dollars. 925 million was their market cap going into 2020. Even that doesn't really make much sense to me. Let me go look at what a good earnings was for them. I'll probably step off of this one pretty soon, but I'm going to go over the short interest data. I just want to see what a good earnings period was for them. I see 2018 was the last time they had like a really good earnings year. In 2018, their revenue, yeah, $3 billion. $3 billion per year. And it's been almost $3 billion every single year since then.
That's kind of suspicious, though. If it's bad, that's similar every year.
Well, I mean, it dropped in 2019 and 2020. It came back a little bit in 2021. It's like differences of 100 million, 1 or
It's not a
200
lot.
million.
That's pretty. That's almost pretty much. That's a pretty amazing.
Yeah, it's like
Normally,
it's like a 3% variance. It's not growing, which is not encouraging. The revenue should be growing, but for the company to be
I would have.
trading sub $1 is very shocking to me.
yeah, but if you kind of look at the sector as a whole, like if you look at Cisco, Juniper Networks, the companies that are within this sector, they're not necessarily growing. They're just kind of maintaining, because the industries that they cater to, they are not growing themselves, because it's retail and the commercial sector. Yes, there are new buildings being built, but it's more that they're demolishing existing buildings and putting new buildings in, replacing the building. That's at least what I've noticed. So when we've been doing deployments, it's just deployments to existing restaurants. It's a McDonald's
Mm.
that closed down. We're going in and putting new point of sale equipment, just a refresh. So I can't see how that would be growth rather than, just them, just the end of life cycle. Because at the end of the day, most of this equipment is not owned by these companies. The businesses that are buying the equipment from Cisco and Avaya, they don't buy that equipment. It's all on lease because it's easier to write off and it's better on their taxes. So there is a life cycle to it. There's a 4 to 5 year cycle that it has to be taken out and then the replacement equipment brought in.
Mm-hmm. I got you. Well, that does kind of smack of stagnation in the entire sector. So I guess that does make sense because I used to manage networks that had these things, and you only replace things when they broke. Like that
Yeah.
that was the only time you ever really changed things out. And I wasn't in an industry that was constantly like doing refreshes, adding new point of sale systems and VoIP systems and things like that. It was just, once you had it, you had it. And yeah, it was an expensive upfront cost, but there was no need to constantly be replacing this stuff. You'd have it for like 6 to 10 years at a time.
Yeah, commercial office settings will have a longer lifespan. They're going to sit there for 7 to 10 years before they replace it,
Right.
versus, the food industry and retail. Food industry and retail, there is a 5 to 6 year refresh.
Right. Okay.
Why is that?
That's
Why
because the
the difference?
stores that's because the stores, they take a beating from the foot traffic. The amount of people that are walking in and out, they wear out the establishment very quickly, and it makes the equipment look dated. And also, it's a way to engage customers for them to want to see what's new and how, to have that new refreshed experience. Because after, like, I'm sure you've been to a T-Mobile store and you notice that after about 3 or 4 years, that T-Mobile store has a new refresh to it.
Yeah.
That's their experience to a consumer to bring
Mm.
you back into the store to spend money. Yeah, it's
Mm.
just
Right.
kind of like their marketing ploy. But that happens as a whole across the retail sector. So like, the IT industry is always kind of revamping them and upgrading their technology because of how smart devices are tracking consumers. Like the retail,
Yeah.
like grocery store chains. Grocery store chains, if you download the app for your grocery store chain, it is actually tracking your movement within the store aisles to see
Really?
how long.
Wow. I didn't
Yeah,
know that.
yeah, definitely. That's something that HEB did down here, and when we were deploying the Avaya Wi-Fi within their stores. That was part of it. They were gauging how long a customer would stand in front of certain product shelves to
Makes
to
sense.
be able. Yeah, because they're creating a Ganter, a gauge of what is the most valuable commodity within the storefront, and that's how
Most
they sell
popular.
it. And
Yeah.
yeah, yeah, it's totally crazy, how they're, you know, gathering
Micro.
this info. Yeah, yeah, microeconomics of how the
Yeah.
foot traffic is going within the
That's
store.
marketing.
It's crazy.
Yeah.
Yeah, way crazy.
Well, I'm
Marketing
looking at the
technology
short
allows them.
interest for Avaya now, and it does seem like crazy high. Um, but there's valid reasons to be short on this company. Like it's speculation either way you go. But we do have a situation where shorts could get squeezed here just because we have max utilization on this one. Cost to borrow is extremely high, maximum 42%. And that's going to go up now and keep going up since utilization's maxed out. The put to call ratio looks like it's moving in the bullish direction and has been for a while. The puts have paid out for the most part. There was a ton of puts that were positioned in June, and ever since then, like the put to call ratio has been in decline, meaning going more bullish. Like once they drop below $1, I would say that most of the bears were looking to take profits. What I'm trying to decide is whether this latest push was a bear rally from shorts covering or if it was something else, but I don't think it was shorts covering. I think that it was a natural rally as their
Dead cat bounce.
maybe a dead cat bounce, but I don't know. It's holding up right now, and it's formed a flag, so that's why I'm kind of hesitating. It could end up forming a head and shoulders, just kind of like at a tilt. But if it breaks to the upside and gets back above $2, then it could keep going. And right now, the short interest is continuing to rise as we've already peaked out utilization. So we're maxed out on utilization. There's going to struggle to start finding more shares to short with. And you're going to have shuffling back and forth between buyers and sellers on the short side. The short interest is at 35%. It's a very small float. Like this, I would qualify this as micro float with them only having 71 million shares. And with a market cap of $161 million, let's just do the math really quickly. See, $161 million. You divide that by 1,000, 161,000. Reasonably, it would probably take a few. It would take a few hundred whales to eat this up. Yeah, at a single $100,000 investment would not even take up like 0.01% of their market cap. So whales would have to be making moves on this stock in order to squeeze shorts. And fundamentally, something has to change for the company in order for them to turn around the thesis on this. So this one's kind of up in the air for me. I feel like this one probably doesn't have as good of a risk to reward ratio. There is an opportunity for a squeeze here, but it would have to come from institutions.
What's the probability, TD, you've got? That's the
I'd
best
say
way of measuring it.
less than 5%.
That tells you where you stand.
Yeah.
Well, it's probably better just to put a $2 alert on it. So if it jumps above $2, start looking at it because there's a possibility
That's a
it
good
could.
idea, Riz.
On the
That's a good
other
idea.
on the other side of it, I would be looking for it to drop again, honestly. I would be waiting for Avaya to drop again and get back below the $1 level because obviously shorts are piling in on this thing and they want to punish it. And I would say just let them, just stay out of their way and let them fall into the idea that like there's nothing that can stop them, that the company's going to go bankrupt and that there's no way to save them. If the
Collect it
audit
on your own.
if the audit comes out with no information of wrongdoing or if it was just simple clerical errors that can be easily fixed and, rectified, then that turns around the thesis that they were fraudulently cooking their books.
Yeah.
For this one, I would say stay out of its way because the risk that there's something wrong here is too great to take a position, but also it's too speculative to assume that the company is outright defrauding the IRS and investors. That's a big accusation to make.
You're clearly speculating because you have no way of measuring whether it's true or not at this point.
Right. There's no way to know. The company is they're publishing a lot of, very bearish statements about, substantial doubt about their financial outlook going forward. They drastically underperformed on their earnings, which was, that's not good either. And all of that is, it's giving bears way too much fuel to continue shorting the company. I would stay out of their way on this one. Look for an opportunity for when the short interest is so unbelievably high. Like if it scales up and doubles to where it's like 50 or 60% of the free float and the stock is trading at less than $1, that's when I might consider jumping in.
Yeah,
But
but even
right
that's
now,
risky. Like you just simply don't know if it's validated or not.
exactly.
Um,
But
it'd
it's
be like a pure gamble. But
right,
the reward would be higher if you're right.
right.
So let's change the equation somewhat.
But that's why I say, like, stay out of their way and just wait to see what happens. Because if the company does get shorted down into the ground and that value keeps decreasing and that's still happening, then you see the price decline to, like, we'll just draw this out. Let me get you guys can see the trading view charts again.
Yes, sir.
Okay. So here's what I see. I see the bull flag. I also see a head and shoulders. Okay. So we have a possible head and shoulders, and if we get a breakdown, then we're going to come back down to the bottom. If this is the scenario that we end up getting, then picking up shares at like 80 cents is way more reasonable for the risk that you're taking on this kind of a play. The benefit here is that you get a larger entry for a much cheaper price, literally like cutting the price more than in half. And say that we're trading down at this level, and then they announce like the audit's complete and the company's fine, there's nothing wrong with their books, then that's 1 point for the short thesis dead, because they're expecting and hoping that they get caught doing something fraudulent and that they'll be penalized by the IRS and people will go to jail. The CFO, the former CFO, was replaced, which I took note of. So if the former CFO has been replaced, then, and he was the one that was doing this, then he would be going to jail, but he's already out of the company. It's bad press for the company, but they can fix things, and they've already front loaded the changes that needed to be made in order to fix things. So since the former CFO is gone, even if there was wrongdoing, they can pin it on him, which they probably would, and it probably is his fault anyway if that's the case. Just saying, because this is something that other CFOs have been caught doing before, like classic case is Enron. And if it's proven that nothing is wrong and the company has not been doing anything like that, then the short thesis is dead. They can focus on improving their sales and maybe pivot their business model a little bit. Part of their problem is likely that businesses are not growing. They're not in a growth phase. So that is going to continue to hurt Avaya's earnings. And that's part of why I'm like, just kind of stay out of this one's way. If it keeps falling, then look for a catalyst that can turn things around and give shorts a reason to want to get out. Because the short interest is now at 30, it's at 36%. Okay. 36% short interest is pretty that's pretty ridiculous. If this doubles and you have all of these shorts that are trading against this stock while it's like at around 60 cents and the volume is like it was back here, then they're not going to be able to cover for more than a week. It'll take them a full week if they all try to cover at one time in order to get the stock back and close out their positions. So bulls can start entering and loading up positions here at the first whiff of good news and then start driving the price up against them. And then shorts will have to try and scramble and start covering once it's already too late and their thesis is gone. You see what I'm saying?
I can smell what you're stepping in.
Thanks. That's a great way to put it. All right.
That was encouraging.
I'll move on from this because we've spent like 40 minutes on this one. I only have another hour.
Can you take a look at Oxy TV?
Let's see. I want to catch everybody's requests that we had in let's see. Scrap Queen had IRNT first. So IronNet we also were looking at. Yeah, this one confused the hell out of me. I don't know why this just dropped to nothing out of thin air. Like the stock was doing fine. It's a defensive play in cybersecurity, and it doesn't make sense to me that they just kind of dropped down They had a 45% drop overnight on no news. It's just no news. There's nothing. I don't
I
know
thought they
why.
did have news.
That can't. It's got to be something.
Let's see. IronNet
Didn't
stock
they have
news.
bad earnings or something? They did drop on some news. I can't remember what it was though.
Maybe it was their guidance.
I believe they had bad earnings, but I'm looking it up. I just was wondering if anybody knew. I'm looking for it right now. Looking for it now.
Okay. Their balance sheet shows that their debt to asset ratio is worsening. Yeah, their assets are declining. Their revenues are not where it needs to be. Cash flow is coming from financing. They're taking on more debt.
Yeah, an article said that their disastrous quarterly results and their CEO, I believe, departed. So there must be some issues with that.
Okay. That's unfortunate. This is probably one that we'll have to stay out of the way of. I wouldn't trade this right now. The company's in too much chaos. And the
I
move to
think
the downside's already happened, so this is probably one to just stay away from for a while.
Which is sad because they were a good cybersecurity play.
I really did like them. I did. I think they were a good play. But if they're not selling their product and they're not getting some customers subscribing to their services, then what can you do? That's what they have to do. If I find it hard to believe that that any cybersecurity company with a decent product could be doing badly in this market right now because everybody's constantly under assault from ransomware and
Yeah,
active persistent
absolutely.
threat actors.
Have you come across any of their product, TD?
Not personally, no, not in my tests. My clients are pretty dated. They've had their infrastructure for a long time. I don't get too many new clients that have been testing out like new and experimental stuff. So I always end up facing off against like Cisco systems, and their security is like they're either running like enterprise. They're usually running like enterprise McAfee antivirus or Norton or Symantec or something like that.
Holy shit, that's aged big time.
It really
Don't
has. McAfee, I think,
don't
was the original.
don't be hating on my Nortons.
Is Norton any? I mean, I have Norton. Should I get away from Norton? I think I have Defender also, but
I don't think there's anything particularly wrong with them. Antivirus has evolved so much that even Microsoft Defender I have trouble with now.
really, wow.
Yeah. Heuristics engines have made it so that like anytime you try to do anything like try and communicate over, we call it a command shell, which is just like the command prompt. But if you try to send a shell over a network connection, heuristics picks that up and is like, that's a sketchy thing to do. Don't do that, and just kills the program immediately. So you have to find a digitally signed program that's built into the system, and you have to find a way in order to inject your code into that program. It's a it's something called process injection, which is it's a well documented method of taking over a program and getting yourself a connection into a system, but you have to have high privileges to do it. So there's all kinds of steps to get there. So getting to that point where you have shell access to a machine with an administrator's privileges has gotten much more complicated, and antivirus has become very good at spotting anything that looks even remotely suspicious. Because it's not
Really?
looking for the way that antivirus used to work is it would rely on virus signatures. Somebody would get a virus, somebody would find that virus, and then they would upload it and analyze it, and then they would take a signature. They would basically take all of the source code of that virus. They would do what's called hashing it, and it's basically where you take an entire string and you encrypt it into a very small bite-sized string, and then you can do the same thing on the host machine. Whenever somebody sees a new program start, antivirus says, okay, I'm going to take a hash signature of this program and compare it to a database of known virus signatures and see if anything turns up. And all you have to do is just modify a little piece of code in order to change that signature. So it was very easy to do. You could get around antivirus very quickly by doing that.
Yeah.
But now it looks at behavior and activity rather than signatures, and then we call that heuristics. And that's so by analyzing the behavior of viruses and seeing commonality between how viruses act and the steps they take to get access to something or to give the attacker remote access to the operating system, that is what they look for. And it's become very, very difficult to get around it. So now,
They're all pretty good now.
yeah, they're all pretty good now. Some are better than others, and some have more features than others. And IronNet seemed like one that was very feature rich, but they're having a hard time breaking into the sector, is what it seems like to me.
CrowdStrike is your friend.
Yeah, CrowdStrike is not my friend. I hate CrowdStrike. It does too good of a job. It pisses me off.
As far as what? As far as the concept, or as far as the?
It does. It's very good. It's very, very good antivirus. It's beyond good. It's the most frustratingly good antivirus that I've ever faced off against.
You're trying to hack. You're trying to hack.
I'm trying to break into it, and it's frustrating as hell.
For a pen tester, you hate it. For a user, you love it.
They need to be selling maybe they need to be selling their as an antivirus package, whatever they've got. If they're that good.
Yeah, for IronNet, I think that my thoughts are to just kind of stay out of its way, and if it continues to push through and get new customers, and it's still growing, if it's able to reduce its expenditure and get away from some of its debt, then it would be a good investment. But for right now, I'm going to have to say, like, this is one to stay away from. Let's go take a look at some others. That was when we were talking about Avaya. Okay, smell my fingers looking at Upstart, GameStop, and Sava. Because of OPEX obligations. I forget what Sava is. Cassava Sciences. I'm not sure what OPEC has anything to do with them. Let's see, Upstart Holdings. This one I'm a little bit interested in because it's at the bottom of its chart and it just put in a double bottom. This is actually a classic diamond bottom right here. So this actually could be a play. So this is a classic diamond bottom pattern. And what gives it away is that it does look like a head and shoulders, but it creates a double bottom where the first bottom dips the lowest and the second one puts in a higher low. And in between is this very large move to the upside. So it almost looks like a bear pennant, but it's coming after a very, very, very long sell-off. This would be the start of the sell-off right here. You could say it's as far up as here, but just based off of where it was trading throughout 2021, I'm going to say it's here because this is a nice range, right? And the whole thing was a head and shoulders. Like this entire pattern right here was a head and shoulders. So I'm going to start the top here. And this is what we're looking for the diamond bottom. And what you're looking for is for it to break this neck. It's looking to break the shoulders here where it consolidated. Okay. Now to measure the move, you draw it from the bottom of the lowest low to the top of the highest high. Move it to the breakout line, and this becomes your take profit. So this is the move that you're looking to capture right here. And you take profit here. What's critical is that you must wait until it breaks out. It must break. If it does not break, then it is a head and shoulders and you will lose a lot of money.
Do you look for confirmation also? You do so it breaks out and then retests and then goes.
That you
Just
can
assume
also
it
do
breaks.
if you want to be as conservative as possible. Yes, you can wait for it to break out, retest, and then do it again. But you can miss the move. Sometimes these just shoot up, right? Sometimes that happens.
Yeah, I
But
was gonna
you
say.
can wait for the breakout, retest of the line, and then take off from there
I
and
was curious what
still
the
capture the
cost
move.
and benefits. I
Yeah.
wonder like what the percentages are. Like if somebody could do like a cost benefit, see which way you come out best overall, like in the long run.
Well, I think that it's easier to look for the breakout and then just get your entry and forget about it and set your stop loss at the lows. Like that's for me, that's an easy way to do it and just not stress
Yeah,
about it. You just set your stop loss at the low side, and if you're right, you'll know really quickly cuz
yeah,
these diamond these diamond patterns usually they don't take any longer than it took for the pattern to form itself anyway. So in this case, this is like that's 2 months. So at most, you expect to wait a couple of months. So you buy some shares, you hold it for 2 months, and you just see what it's doing. And you'll once the move starts going in a particular direction, then you know that you're right. You just hold it until you complete the move and then take profit.
right. That's just something like one of your bots or the Lux algo would say sell, right? It would come up at that 41. You could set it
Mm.
to sell.
I'm willing to bet that if you put the Lux algo on this one, it would probably put price clouds in here as well. This is a good buying area. Like you have classic double bottom. You have a double bottom between this low and this low, and another double bottom between this low and this one
Hmm.
because they both crossed into each other's target entry area, but none of them ever broke below. So as long as you get this breakout here, then I mean you can enter early, but I think that it is the wisest choice to always wait for confirmation, wait
Yeah,
for a candle to close up here.
yeah.
Don't wait. Don't look for a wick because
I,
if you get a wick up and a rejection on a tombstone candle, then you'll be very sad.
yeah. You mean the candle fully has to be
Yeah, the candle has to close with
above the candle before?
the body has to close above the breakout point because notice that all of these candles they wicked up and were rejected.
Yeah,
This one had its first breakout attempt here at previous consolidation range right here. This was consolidation. It tried to get above this and it failed, and this is the move that tells you, okay, this is a diamond bottom. And now it's going to have to retest the lows. So you look for confirmation that it is in fact a diamond bottom. You got it because it closed
like
above
how
these
come it's called?
candles.
Why is it called a diamond bottom? It doesn't. It looks like a kind of a triangle. How is it? Maybe I'm missing
Um,
something. I'm sorry.
because a lot of people draw these lines like this, and you see
In the
it
form
looks
of a diamond, you
yeah,
mean more
it
like
kind of forms like a diamond like that.
Oh yeah, I see. I see what you're saying.
Yeah,
Yeah. So,
I just don't draw the complete thing because it's time consuming and
sorry.
unnecessary.
Yeah.
No, it's okay. This
To an amateur like me, I had to
no,
understand
no,
that.
no, dude. It's not amateur. I learned about this pattern. I learned about this pattern about 2 months ago, and it was I thought it was kind of cool.
If it works, it's really cool.
Yeah, if it works, it's really cool. And so far, the ones that I've seen, they do work. If you want another example of a diamond bottom, I drew one on Big Lots. That's BIG. This is another one that did it, and it's even better setup. Honestly, you had you had the drop to these lows, and that was what actually like formed the bear flag part of this, and it broke down to the downside, and then had a huge impulse move to the upside. And this is what gives away that it is a diamond
The
bottom
impulse.
that's forming.
The impulse.
And then you have the impulse rejection, and it creates a higher low. And as long as you never get across below this area, or rather, you never get a cross below this low, then
Mm.
you anticipate a move to the upside. You break out here, and then you capture this move.
Mm.
And this white line is just the distance between this low and this high.
I just have to study that more.
Yeah.
To understand
Now I
it.
like BIG because this is a consumer defensive play that they do discount stores and they have very cheap furniture. They have goods and for like lawn care and home improvement.
Yeah,
They've got
we bought
they've
some
got
furniture
food.
from there.
Yeah,
I
it's
bought some furniture from there, so
decent store. They got decent product and it's very cheap. So people will be going there for all their necessities and anything that they're looking to get a deal on. Because things are just going to get harder. It's just going to get harder.
yeah.
Let's see what other plays we've got here. We'll check out GameStop and we'll do AMC as well. GameStop
That
was
wasn't me,
looking
guys.
very nice.
I did not say it.
It's all good.
After a few weeks ago, when I did that domination.
All right, so GameStop had this nice pop and consolidation. I'm thinking that this is actually part of a bull flag. Let me bring this down to the 1 hour chart and put my moving averages on this. GameStop is starting to look like it's going to move. The consolidation was really nice. It took some time breaking out above its 100 period hourly average, but this, oops, come on, give me my brush. So we had this big move here, bumping my mouse at the same time. Had that pennant forming. And now we've consolidated and have been slowly chopping our way through our moving averages. And now we finally crossed above all of them. So I would anticipate that the next move from GameStop would be this leap up to the 200 period hourly average. So somewhere around $32. I called this one out last week and said that GameStop looked like it was going to make a move to $33, $34 before October. So far, it looks like I was right, but we'll see. Let's check out AMC. This one's not as good looking, unfortunately. We had a bull flag that had an attempt to break out, and it got rejected, and now it's formed a double top. So we had this bull flag that was setting up, and then we came up and touched and then got rejected pretty hard. Now we formed this double top pattern. Now we're at the neckline. If we bounce and can't break out above this area, we need to get back up to like $10 or so. If we get rejected by this, then unfortunately I think it's coming back down to retest lows. So not ideal. AMC had a really rough week last week. SST. All right, we'll take a look at SST. I know that this is another squeeze play that I was calling out. And again, it got rug pulled on an insider sell. Sold 1.3 million shares. What a dick. Well, if you ever wanted to send a signal to investors not to invest in your company, that was it. So we're now at the falling knife phase. We had this drop that was just so severe. I think any idea of a gamma squeeze is dead now, probably because I talked about it. The only bullish thing that you have going for you is that the MACD is crossed to the upside. They moved. What doesn't make sense to me is that this move is so delayed. Like, they had a terrible earnings announcement here. Their stock price went up and consolidated above all of its moving averages, and now just suddenly just takes off to the downside. And that was several days after the insider sell. So
And you know what's funny is that people are actually paying money to go see old movies at AMC theaters. Old movies, not, I mean, really old movies. And they're paying money.
that's
Not
pretty
even
cool.
new. Yeah,
Hey, pay for the experience.
exactly.
Well, SST has broken this trend line, and now we're doing lower lows. So that's at this point, it's like just it's not the time to get in. That's for sure. I don't know who hates the company more, the people who own it or the people investing in it, or the hedge funds trying to short it into bankruptcy. But yeah, this is past the time to exit. Do we have any other requests? Any other short interest on SST? If I recall correctly, it was pretty severe. Yeah, short interest took off right before the insider sell, so somebody knew something. Probably told all of his fucking hedge fuck buddies that he was going to announce a sale, and they all jumped into short positions. Like a full 1.5 million shares short just overnight, out of nowhere. And now the stock is just taking off to the downside. After it got off of the threshold list, the day after it gets off the threshold list, that's when they enter into their short positions, and then the insider sale gets announced. Massive failures to deliver. Dude, I don't even know why I bother, man. There's not a one of these company executives that really give a shit about what their company is doing or how their investors are doing. They're just in it for themselves at this point. They only care about the banks that are giving them all the money to do this shit with. Okay. That's the one that we're talking about right now, Chan. The biggest thing is that the huge insider sale. 10% owners sold more than 1 million shares at once, and there was a bunch of shorts that got into their position before he released his Form 4. So somebody already knew that he was going to sell shares. He told somebody. They knew. They got a bunch of puts and sold short, and now it's taking off to the downside. And now they're just hammering it. So they have full control. Insider trading.
Yep.
Yeah, if it's oversold or not doesn't really matter. They have full control of it. Don't get in its way. You're like that's the definition of trying to catch a falling knife. Just stay out of its way. Let them take it down. They'll bring it back up whenever they decide to, and they'll try to make money off of retail the whole way. So just stay out of its way. Hell, buy puts because they have full control. This is no longer the time to try to fight the good fight and try to fight hedge funds. This is all. This is about staying alive, keep your profits up, look for opportunities where you can find them, take advantage. Don't hesitate on those opportunities. But we're not going to be playing. We're not going to be playing these squeeze plays for the most part. I know this is what everybody wants, because everybody wants the get rich quick instantly. But we're not in the right market for it. The speculation is over and the excitement is dead. And
In
right
general,
now,
or just with this
in
particular?
general, really, like just to be frank, things are not, this is not the environment. It's not ideal market conditions for squeezes to happen. There will be squeezes during this market, but it's going to happen almost at random when hedge funds that have been long in most things and short in others, the ones that they were massively short in when their primary portfolio positions go down and they have nowhere else to go, they're going to they'll be forced liquidated. And that's what will cause those short squeezes. The forced liquidations will happen.
Yeah, that's what we're waiting for.
Yeah. Let's instead take the time to go look for some new things and let's inspect where the shorts are currently spending most of their time, or where they're spending most of their money, I should say.
Yeah, I was reading that right now in the current market conditions that this is one of the most difficult times for new or inexperienced traders to be in this market.
It is. It's a very dangerous market because of the unpredictability and because you have major funds that are over leveraged that are trying to stay afloat and they're doing everything they can to try and keep themselves alive. If they fail at any point, it will cause them to be forced liquidated, and that's a disastrous thing for everybody because it causes huge moves that happen instantly, like overnight. They'll be forced liquidated into either selling assets or buying short positions back. When that starts happening, these guys get destroyed. And anybody who was caught on the wrong side of that trade ends up losing tons of money. And that can cause other forced liquidations, and it creates this domino effect.
Domino effect, absolutely. If
Yeah.
they're big enough. Mm-hmm.
The smallest funds that are over leveraged just enough can create big problems down the road for everybody else. So let's take a look at some of these. This is the Ortex screener. I like to use this to go and look for other real squeeze opportunities and catch up on, where value actually is. I have a few settings that I put up here. For one, I like to see a positive PE, that's price to earnings ratio. I like to set the estimated short interest to be at least a minimum 20% and the free float on loan to be a minimum 20%. And then I sort by the estimated free float, estimated short interest percent of free float. So I put that in descending order so that I'm seeing the most shorted stocks first, and I'm seeing the ones with the highest free float on loan. And I make sure that my PE value is positive, so I'm filtering out all the garbage that is just like, is just nothing but a money losing company. Okay. Now a PE ratio, the higher it is, doesn't always mean good. PE value should be positive, but it should be between 20 and 40 to indicate a good deal. So right now we're looking for companies that are cheap versus what their earnings are.
Right.
If you go too low on the PE ratio, you're scraping the bottom of the barrel, and you might be buying into a company that's going to start losing money in the future. It might mean that their earnings is in decline, and you don't want that.
Yeah.
But if their PE value is too high, then they're too expensive because their price is extremely expensive versus how much money they're generating. So this is how, and you're looking for like that good middle ground, right between, like, you could go between like 5 to 40, but a nice, like, the closer to 20, that's ideal. 20 is pretty ideal for price to earnings value. That's just been my experience, and like a fundamental analysis thing that I learned after reading a little bit more from more experienced traders than me. So
Tesla is 26.
interestingly, Avaya turns up on this one, and Avaya is the one that's close to ideal. So Avaya is in a good spot, but its earnings are in decline, and
Well, it's under
they
investigation.
have all
It's
those
under
problems.
investigation. Yeah.
Yeah. So we'll keep.
That's where fundamentals come into play, right? That's where
Yeah.
you have to do all the research on the company, see what you're
Yes. Yes.
management,
Yes.
and see what you're dealing with.
Exactly. So we'll keep an
Now,
eye
for
on it, but we're
These are
gonna have
good
to wait.
candidates, and then you have to do the research from there.
Yes.
Is what you're saying,
Yes.
which is true.
but with
CEO.
enough retail sentiment, that could also influence it and be a catalyst to get it over the hurdle, right?
It could, yeah, but we're looking for the best candidate to start with and go from there. We don't want to take. We want to take the best candidate possible, find the diamond in the rough, and polish it so that it gleams just enough to get everybody's attention on its own. And that's enough. That's enough to get the ball rolling. If we find just the right company that's in that perfect position where it has been sold to the bottom of its charts, the bears are overzealous and over leveraged, and the company is just now starting to turn things around where the bears haven't noticed and they still think they have control, and it's just before bulls have taken notice and realize that they have something with real value. When we find those companies that are just in that perfect spot, that's where you can find the huge runners. So this is my method for finding those opportunities. We find the tickers and then we start looking. One that I've been looking at for a long time is actually Groupon. Groupon I've been paying close attention to. The one thing is I know the chart still is too expensive, and because the PE value is so high. Like Groupon is trading
Where's the
at,
PE value?
it's
On
at
this
the very
chart?
far right, very far right.
Oh, I see. PE value.
Mm-hmm.
Okay.
Yeah, Groupon is still expensive because they're not making very much money. They're actually losing money. Okay, so another one that I had looked at before was World, WRLD. That one's too expensive. It's $114 per share. They're a micro float, but that doesn't really matter when their share price is that high. So let's not worry about that one. MicroStrategy, their PE ratio is way too high. I need to put a cap on this. Let's put the PE value in a range and just drop everything that's triple digit PE value because we know we're not even going to look at those. Tesla has a PE of 109. Yeah, Tesla's way overvalued. Like that's an at face value way to see if something is overvalued. If you see the PE ratio at triple digits, then it's overvalued. Because that means that that for every dollar you invest, this is how the PE ratio works out. This is what it means: is that for every dollar you invest, or the PE value is the dollars you get back. God, I have to actually look at
I
the
think
formula.
it's right. I think it's okay because in other words, if you invest $109, you earn $1.
Yeah. So
Right. So that's the way it works.
yeah, this is the number of dollars you have to invest to get back a dollar. That's right.
Like CPA. Sorry.
Yeah. So in the case of Tesla, you would have to spend $109 to get back a dollar, and that's expensive. But if you have something like Vertex Energy is in a growth phase. They're very cheap. Their price is at the bottom of their chart. I've been actually looking at that company for a while. They're a nice, they're a green energy play, so it falls within my my ethical standards for companies' business model. And for me, this price to earnings ratio would be $3.70 to earn back a dollar. So I get my money back after just less than 4 years if they did absolutely nothing different. In theory, that would be if they were actually paying a dividend of some kind, but
Well, the stock price will reflect it. If not,
Yeah,
the
yeah.
other
The stock
one
price
way or
would
the other.
reflect it. So Vertex is one that's it's very close. If I look at their chart, BTNR, they're getting ready to put in a bottom. I think they had a double top pattern most recently on their daily chart where they couldn't break above their 200 moving average, and now they're testing the bottom again at $6.90. So if they turn around here and they put in a nice bottom, they're adding support here right now. So we'll see how it does. But this one might end up declining more. So probably wouldn't want to jump into that one right away. Rocket companies. I think this is Rocket Mortgage, if I'm not mistaken.
You say Rocket Mortgage?
Yeah, I think so.
Fuck them with a cactus.
Yeah, I lost money on Rocket Mortgage before.
That's how you really feel.
I lost a house because of them.
You lost a
Oh.
house because of them.
Yeah, they dropped the ball. They did not get the appraisal done before my contract expired.
Oh.
Oh, those
I'm gonna just
bastards.
retract all joking right there.
That's rough. I'm sorry, dude. That sucks. That's shit. Well, maybe you can get your money back because I see a diamond bottom, but they are a mortgage originator, and we're in a huge bear market right now. We're looking for a confirmation bottom on this chart. So you'd be looking for the price to bounce off of around $6.50. If it bottoms here and bounces, then you have a good chance to see a diamond bottom reversal on this one. But this one still needs time. Give it time. MACD is looking bullish. RSI is starting to move in the right direction. Needs to test and it needs to break and test the moving average on the RSI for the daily chart. So this is going to take time. I realize I wasn't sharing my screen on that, so that's not helpful.
So I got Rocket Mortgage back where it hurts. Every realtor in my community refused to take clients that were using Rocket Mortgage as their lender.
Wow.
Ooh, ooh,
Ooh.
rough. That's payback.
But nice.
Sell some really interesting financial instruments. Like they do like a Fannie and Freddie 30-year, where you actually the PMI actually falls off instead of like some of the FHA 30 years now, where the PMI never falls off. You got to refi. You can do a conventional to them and go off of this Fannie and Freddie instrument. I'm sure it's a bit fugazi and probably makes them and Fannie and Freddie a shit ton of money and doesn't like help the buyer out. But it's something when I was buying a house, I started digging into all the financial instruments that people offer in different models.
Mm. All right. There's the chart on Rocket Mortgage, guys. If you wanted to copy this onto yours, I'll give you a minute to do that. But this one, we have to wait for the real estate market to improve. Mortgage lenders, this is the wrong market to be investing in mortgage lenders. So this could end up being a false break top and end up breaking to the downside. So I would say give this one plenty of time and stay out of it until conditions improve if you're going to try to play this. The pattern is looking nice, but it's not complete yet.
Puts.
It's a bit close to the bottom of the chart for puts, is why I hesitate to say that. If I had seen this breaking down, then I would have said, okay, puts. Like at like $9, then I would have said puts. But now you're kind of forming a double bottom right now, so it might end up bouncing to the upside. There's going to be chop for a while before it makes a decision, so there's probably not that much of an opportunity to make money. But keep it in your list and watch it.
Yeah, and I'm sorry for shouting it out because I'm going to be
You're good.
puts always on Rocket Mortgage.
Revenge trading.
1,000%.
All right. Apollo Medical Holdings was another one that was in this list, AMEH. They have 31% of their float sold short, which is interesting. Their income is improving, and they're in a defensive sector for healthcare. So that's actually a good setup. They're in the right sector. Defense and healthcare are going to continue to perform throughout the bear market. They will still have pain. Nobody's exempt from pain, but this is the best opportunity to see a squeeze out of the options that we have seen so far. So short interest is very high. Very high. And it's been high for a long time. Interesting. Utilization is nowhere near maxed out. It's been dropping. But it's never been anywhere near maxed out. Free float on loan. This one probably is not a great candidate. It seems to move very slowly. It is expensive. There's heavy short volume trading in this one. Failures to deliver really aren't all that high compared to its free float. No, I take that back. It is pretty high. I didn't realize that it was such a small float. It's only it's a 38 million share float. So this is actually 10%, almost 10, not 10%, 1%. This is almost 1%, this failure to deliver spike that happened back here. It's so interesting because I normally don't see massive failure to deliver spikes unless there's extremely high utilization. Maybe somebody sold way too many naked calls and got margin called. I don't know.
Should have put clothes on.
Well, let's see. This one might be a good long investment, but in the short term, you could probably get a better price. But it just might not be the squeeze that I thought it could be. I'll head back to the screener and see if we've got any others. That's Big Five Sporting Goods. They do seem to have found a bottom. They've been slowly working their way back up from a low of $10. They had a recent high of $15.60. I'll keep an eye on that one. Let me see. Are there any others in this list?
What about Kirkland?
Kirkland. Their price has been in decline by 11% this week. Microvision is down 7% this week. Let's see.
Yeah, but Kirkland might be coming into their season because, they're like a seasonal retailer with Halloween coming.
Really? Oh, yeah. It does look like it's
cyclical.
Okay. Yeah, Kirkland
sorry,
does
my
seem
daughter's
to
right
have
here
a.
with me.
Kirkland does seem to have a diamond bottom pattern. Oh, you know what? No, this is inverse head and shoulders. It's a really wonky one. Okay, let's take a look at their chart. We'll take a look at their Ortex and their chart. Free float on loan is 24%. It is definitely a micro float. Their utilization is pretty high. Cost to borrow is rising. Average of 11% cost to borrow. Short exchange reported volume is matching up pretty closely at 28%. Okay. That's pretty close. Okay. How long have shorts been in this? Okay. This was a short rally. They got out of their positions. So shorts are starting to get out. The days to cover are dropping as well. Okay. Yeah, shorts got out of their positions, or at least a lot of them did.
So should we look for them to potentially re-enter?
Trying to figure it out.
Holy fuck! Look at the weekly on that thing.
The weekly on what?
On
Kirkland?
Kirkland.
It's almost on the base on that weekly, isn't it?
It's been down to 52, 56 cents twice on the weekly.
Yeah, you're right.
Are you guys talking about this span from 2019 through 2020? Like way back here? Is that what you're talking about?
I think it's 2008 to 2020.
It's interesting that it was so quick to recover during the recovery of 2009. I find that particularly interesting. It also exploded during the COVID pandemic.
I was just getting ready to say, why did it explode during COVID?
What do these guys sell? They're a specialty store. What do they do?
Kirkland's Costco.
Oh,
So think about the run everyone did on food and toilet paper and stuff. That's why they exploded.
gotcha.
Yeah, they're like a boutique store, a little bougie for people that don't want to go to Whole Foods.
Bougie.
I mean, that's what it is. It's more expensive than Whole Foods. I'm
No,
sure
I
you guys know
agree.
what that is.
No, it definitely is. It definitely is. Yeah, I know the types of people that go there.
Yeah, and I put the ticker up for the weekly. I mean, that's almost like at the base of where it started before in June of 2020.
Interesting. Okay.
I don't know what Kirkland is for you guys out there, but Kirkland for us is just like Costco's brand. It's like their label, and they're a wholesale, like members only club, like food place, like large wholesale. So you buy things in large bulk.
Framed
Yeah,
art, mirrors, wall
these-
decor, candles, and related items. Decorative accessories, textiles, garden products, garden accessories, floral products.
They were at their bottom in 08 and in 2020, and they popped off of both of those, which is whenever the market was in a downturn.
Interesting.
Yeah, because they sell everything. So you go there to get, you buy clothes, food, snacks, camping gear. Like it's like an upscale Walmart almost. At least for us out here in California.
Okay.
Yeah, same down
Interesting.
here in Texas.
I just
Very
find
interesting.
that very interesting.
Man, I feel like you could create a crash index out of this thing.
Right? Because it's following it.
When did it pop? If it if it started popping in, okay, here's September of 08. This thing looks like the freaking yield curve.
Exactly. That's why I was saying it's like
This looks like the 10-year and 2-year treasury curve. Look at this. It looks like the 10 and 2-year treasury curve. It even kind of matches a little bit.
Can you show it? I'm only seeing Ortex still.
Oh yeah. Okay, so candles are the chart and orange is the yield curve.
Wow, it really does.
It
follow
looks like the yield curve. That's hilarious. It moves with it too. Like the yield curve actually kind of leads this a little bit. Okay, all right. You know what? Oh wow, that's so wild. That's wild and hilarious. So we had a yield curve inversion in 2020 and 2019, and that was when Kirkland hit the bottom of its chart. And as soon as this came out of inversion, Kirkland took off, and now we've inverted, and we're re-inverting again. We're going into a deeper inversion. So I wonder if like just go long on Kirkland calls for like just do like leap calls on Kirkland as soon as you see the yield curve uninvert. That's usually a crash signal. But how hilarious would this be if this stock just squeezed and took the hell off during the recovery?
Well, you found it during the Ortex scan, so it's there.
This is funny. It took a year for it to hit the top of its chart starting in March of 2009, which was exactly when the recovery started. So the recovery actually began exactly in March, and that was when the quantitative easing came back in. And the market was at its lowest point. The retail or the real estate market was at its lowest point, and then Kirkland took off for the rest of that year up until next spring. So you could actually look at the point where the yield curve uninverted, and you would have gotten at almost exactly the low on this thing right as the market was crashing. And then after the quantitative easing came back in, yeah, right after the market crashed, this thing took off. Okay, I'll be looking to go long in Kirkland now once the market crashes. So that's how I'll make my $1,000,000. I'll just wait for this. I'll just be like, nah, forget about going short on the market. Fuck that. I'll wait until the market just dies and spontaneously combusts, and then I'll just go long in Kirkland.
Oh, their float is only 11 million.
That's wild.
And at
Would-
least for me, all the Costco's around me that sell Kirkland, they are always packed and super busy.
Mm. Let's see. What is Costco's chart looks like? I wonder if it's any similar.
Can you
Not
imagine
really.
in Kirkland at 50 cents and selling at 32 bucks?
It is weird how dissimilar their charts are, considering that Kirkland is like the Costco label for us. You know, it's like the Ralph's brand versus buying name brand.
Well, I'll tell you what. I've never seen a chart so closely follow the yield curve. So, wow, this is hilarious, dude. That's
Want to
absolute.
help?
That's a 3,000% move in 2 years. 3,000% in 2 years. That's silly. 800% if you got in after the yield curve uninverted. Yeah, I'm just going to wait for the market crash. I'm going to wait for the market crash, and I'm going to buy leaps in Kirkland.
Yeah, can you help keep us updated on that?
Yeah, I'm going to do that. I'm going to do that. Absolutely. As soon as the yield curve uninverts, I have an alert for the yield curve uninverting. I'm just going to be like, I'm just going to add on to the yield curve alert that says the yield curve has officially uninverted. Go buy Kirkland.
Trading view alerts, there you go.
Yep.
That's great. I love it.
This is silly. That's silly.
Yeah.
Is there
Yeah.
any more news about John Colucci at all?
John Colucci. What about him?
Has there been any more news, or are they going to throw the student
Oh,
handcuffs?
with Big.
Not
whole
at
thing with Big,
not
yeah,
at the
yeah.
moment, but I do think I have a lead on a story. I don't want to drop it here because I don't have confirmation yet, but I think that we might have some big news coming soon. So I'm gonna be doing
off
another
on that.
BBIG video soon, but I think that I have a feeling that we are coming to the end of this court case. We'll see.
That would be good.
Yeah. I'll give people a heads up if anything fundamental changes with Vinco. But for right now, I would say that it's a good time to consolidate your shares.
Yeah.
Right now is a good. Right now, it's looking very good.
And it's also a good time to head over to the merch store.
Thanks for the plug, homie. Yeah. If you guys
Put
want to
some
check
mug.
out the new merch store, it's at shop.hellstradingfloor.com.
Even if
What
you
kind
don't
of
have an
merchandise?
office, the coffee cups would look great on a nightstand.
I can't wait.
You
I
guys selling
gotta
coffee cups? That cracks me up.
I gotta
I'd
get
buy one.
myself I gotta get myself an order for a Hell's Trading Floor mug. I definitely want to get myself one.
Yeah, we all should.
That's sick. I will definitely head over there. Great plug.
Okay. That's gonna be it, guys. I'm gonna go ahead and close it here. Thank you guys for hanging out this Sunday afternoon. I look forward to seeing you tomorrow at the Bill.